Hello everyone, hope you're all doing great. Welcome back to another video on the NFTraderr channel. In this video, we're going to take a deep and detailed look at new day opening gaps and new week opening gaps. You might know them as NDOG or NWOG. You've probably seen Michael and other traders mark these on their charts. I'm going to break everything down for you and show you exactly how you can get the best use out of them. This video is basically useful for anyone trading with the ICT style, because you can use these concepts to build bias, to find entry points, and even to identify market conditions where you shouldn't be trading. So before we jump into the lesson, make sure to like the video right now, and if you haven't subscribed to the channel yet, hit that subscribe button. Alright guys, first I want to give you a quick explanation of these new day opening gaps and new week opening gaps, and what the actual difference is between them. I want you to pay attention to the new day opening gap that formed today. Look here, November 27, 2025. We're on the 1 minute time frame, and let me tell you right away, it doesn't matter what time frame you're on. You can mark it on the 1 minute chart, on the daily chart, it's all the same. Let me scroll back, until we get here. Now look at the time down below. It's 4:59 p.m., and then we have 5 p.m. New York time. Everything I teach is based on New York session timing. If you trade using New York time, you already know that the market closes at 5 p.m. for 1 hour, and then it reopens exactly at 6 p.m. During that 1 hour window when the market is closed, news can come out that pushes the indices higher or lower. So here's what happens. The price at the moment the market closed was 25243, but the price when it opened 1 hour later was 25,258. This difference, the price gap that forms during the 1 hour the market is closed, is what we call a new day opening gap, or NDOG. And this is how we mark it. From the close of the 4:59 p.m. candle to the open of the 6 p.m. candle. Just like that. Let me zoom in, that's the exact open. And yes, this is also visible on the daily time frame. If we switch to the daily chart, the gap is simply the space between the close of the previous daily candle and the open of the new daily candle. See? It's exactly the same thing. So this right here, that's the structure of a new day opening gap. Now, what is a new week opening gap, and what's the difference between that and a new day opening gap? The way you draw it is exactly the same, and it works the same way too. The only difference is when you draw it. To mark a new week opening gap, you need to go to the first day of the week, which is Monday, and that's where you draw your NWOG. You can even use the weekly time frame if you want. On the weekly chart, all you have to do is measure the distance between the two weekly candles. For example, here you can see a small gap formed this week. This is last week's candle. I've marked its close. Now I go to the open of the candle for the current week, which is this one. That distance becomes your new week opening gap. If you switch to the 30-minute time frame, your chart might look something like this once you draw it in yourself. Alright, now let me tell you what these new day opening gaps actually do. In the 2023 mentorship, Michael says something really interesting. He says that these new day opening gaps and new week opening gaps are basically the same support and resistance levels that retail traders use, except these are the real ones. That's exactly how he puts it. If I translate that into simple terms, they're the same support and resistance levels you first learned when you started trading. The difference is that these are the true, main support and resistance levels of the market, while the ones we used to draw, those horizontal lines we all marked in the beginning, are nothing but liquidity. And as you can see, the market reacts to these levels beautifully. Price drops, comes back up, taps it, reacts again, moves up, sells off, hits it again, bounces, moves higher, breaks through. You can literally see how much the market respects these levels. This is where you need to lock a phrase into your mind. New day opening gaps and new week opening gaps are price magnets. Why are they called magnets? Because price gets pulled toward them. Price always tends to return to these levels and react to them. Michael even says at some points that you can use NDOGs and NWOGs just like FVGs. He literally says they're no different from an FVG in terms of usefulness. Alright, now I'm going to delete all of these and just use the indicator, so we don't have to manually mark them on the chart every single day. As you can see, the indicator marks exactly the same area for us. These are the ones we drew manually. I'm going to remove the new week opening gap lines as well. Just like that. So let me explain a few things about this indicator. First, it's better to keep the settings like this. You should always have one new week opening gap on your chart, and at most 5 new day opening gaps marked. This is actually what Michael himself recommends. Now let's take a look at how price reacts to them. You can see how strongly the market reacts to these lines. Here, price closes below it, reacts, and drops. It behaves exactly like an FVG. When price closes below an FVG, it moves downward and sells off. Many times price also comes back and gives another reaction. See here? Again, price closes below the line and drops. Look how many reactions we get. Reaction, 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 and another sell-off here. Price reacts again, closes above it, reacts, reacts, reacts. You can see how strongly the candle bodies respect these new day opening gaps. This is why I told you that you can even use these levels to determine your bias. For example, when price gives a strong close above a new day opening gap on the 1 hour or 30-minute chart, then you can shift your bias to bullish and trade this entire leg from here to here. This is honestly one of the easiest ways to build bias using new day opening gaps. Now, there's an important point here. Michael divides NDOGs and NWOGs into 4 sections, but honestly, for now just focus on the midline, which he calls the consequence encroachment. That middle line is your C, basically the 50% level of the opening gap. And this 50% level is extremely important because price reacts to it very strongly. So, what have we learned so far? We learned that new day opening gaps and new week opening gaps, which function the same way, can be used as rejection levels. What does rejection mean? It means they push price away. For example, here price gets rejected to the upside, and here it gets rejected downward. So you can use them exactly as rejection zones. If the 1 hour time frame gives you a reaction like this, then on the 5-minute time frame you can almost guarantee there was a clean trade set up there. It works just like the support and resistance levels you mark on your chart, levels where you expect a reaction, and then you go to lower time frames to take the trade. Let's zoom into this example here. Price taps into a 1 hour FVG. Let me mark this FVG. At the same time, this FVG overlaps with a new day opening gap zone. So I drop down to a lower time frame and wait for my setup to form. Here we get CISD, price closes above it. Then we get a SMT divergence with Dow Jones here. Right here, we can take an entry. Stop goes below the order block, and the reward runs to positive 2 SDDV, hits our target, and completes the move beautifully. Even on this 5-minute time frame, if you look at the new opening gap, you can clearly see how many reactions price gives. Reaction here, another reaction. We see, price closes below it, you see the close right here, and then price dumps. Here price closes below it, and drops again. Closes above, pushes upward. You can see it acts exactly like a support, resistance level for us. Now there's something very important I want to tell you. These new day opening gaps are basically the same thing as the daily open. You can use the daily open to identify manipulation zones. Meaning what? When you're bullish, and price dips below the daily open, that often creates a manipulation, and usually the rest of the day ends up pumping upward. And what we're seeing here is the exact same scenario you'll see over and over again in live market conditions. What does that mean? If we consider this level as accumulation, then this move down can be the manipulation, especially because it forms right below the daily open. From here we can look for SMT, and then trade to the upside, because this is likely to become a distribution leg. So that's another key use case of opening gaps. You can use them to spot manipulation, and then trade the distribution move that follows. Now, the next important point is knowing when not to trade. Guys, when price gets stuck, like here, between 2 or 3 new day opening gaps or new week opening gaps, what do we usually see? A consolidation phase. I've mentioned this before too. Whenever price gets trapped between multiple opening gaps, we usually get a range. And we only break out of that range when we finally get a strong close above or below these NDOGs or NWOGs. But look here, price is stuck between NDOGs. You can see price reacting to all of them. It's like the market is trying to satisfy every level. Some of these opening gaps want to drag price upward. Some of them want to pull price downward. And what does that cause? Consolidation. These levels help you spot ranges very easily. So this is another thing you have to pay attention to. Use these levels to identify accumulation zones or ranging conditions, the times when you should avoid trading. Alright, the next key point is using opening gaps to find your bias. There it is, a new day opening gap has formed. We talked about how around 7 p.m. New York time, we expect the market to return to the new day opening gap. And as you can see here, price comes back into the NDOG. For now we don't care about how to trade it, just notice the return. Now let me explain this for traders who trade the full New York session. Here we are in the London session, around 2 a.m. So how do we use NDOGs and NWOGs as bias? Whenever you're below the new day opening gap, you can expect that most of this move is probably manipulation. Meaning everything happening under today's NDOG is discounted, and discounted price is the best zone to look for buys. Even better if it aligns with an FVG, and that FVG has been respected, price hasn't closed below it. Well, we are in a bullish context, and we expect the price to find support inside this FVG and move toward the NDOG. On the 30-minute time frame, we have an FVG and also an order block right below it. And since we are below the NDOG, we interpret this move as a manipulation and a push toward the premium zone. Our CISD has been confirmed on the 30-minute time frame, so we drop down to the 15-minute to find an entry point. On the 15-minute chart we have another clean FVG, so we mark that as well, and we can see that price has reacted to it. The CISD on the 15-minute time frame is also confirmed, and a new FVG has formed under it, which we can use as our entry. We enter on that new FVG with a stop below it, and our target is the NDOG, and we see how beautifully price moved toward it. It even retested it like a support, and then continued higher. This is exactly why so many traders use NDOGs and NWOGs on their charts. Another important point is right here. Always remember, guys, when an NDOG overlaps with an FVG, that FVG becomes much stronger and the probability of it failing is far lower. FVGs that form on these opening gaps are extremely high value. If you want to trade NDOGs and NWOGs, they need to be part of your structured plan. So this was a bullish example where a full market maker by model formed, and these were the setups we could take on the way up toward the new day opening gap. Alright everyone, that's it for this video. I hope you enjoyed it and got real value out of it. I'd love to read your thoughts in the comments, so make sure to drop a comment for me. Wishing you all health and success. Until the next video, take care.